Hello, I'm Hunsley from Livewire Markets. And to quote the words of that inimitable public figure, Federal Reserve Chairman Jerome Powell, the time has come for interest rate cuts in the United States. Markets have been hanging out for this first rate cut for months now. But what happens after that? Joining me to discuss this and the many other issues in markets right now is Ron Temple, Chief Market Strategist at Lazard. Ron, it's always good to have a chat.
Happy to be here. Thank you.
We last spoke about 6 months ago, actually, when you were last out here in Australia. And you said at that time that you'd still rather buy equities over bonds, even where valuations were at then. Would you still rather buy stocks over bonds today?
Yes. It's a pretty straightforward answer. I mean, if I look at bonds today, if I look at 10-year yields in the U.S., around 3.8% to me is not an attractive valuation point to enter a long duration trade. If I look outside the U.S. at other markets, similar levels, a little bit higher in Australia and the U.K. But bottom line is, I think in the bond market, there is downside risk in terms of price, because when I look over the next 12 to 18 months, I think 10-year bond yields should probably be higher than they are today, even while the Federal Reserve and other central banks cut rates at the short end of the curve. So it's partly a negative view on bonds that would basically lead to this conclusion. But then secondly, it's just, I think the equity market is positioned to have decent earnings growth for the next year to 2 years. The US economy and other major economies are in good shape. I would note, by the way, it's interesting, in the last few days and weeks, consensus expectations for US GDP growth have bumped back higher, now to 2.5% for this year. I'd been more on the kind of 2 to 2.25%. Still think people might be a little too optimistic, but let's be honest, anything with a 2 in front of it is a good number. And that's a backdrop where you could see earnings growth for the S&P 500 of around 10%, which means I've got earnings growth driving valuations, unlike bonds where I've got downside risk from higher yields.
It almost sounds like you've got a higher conviction buy on stocks down than when you did 6 months ago. Did the snap sell off and the volatility spike in early August help that?
Yeah, I think, honestly, I do think what we saw in August, and let's step back for a moment. Basically, in August, what we had was one bad payroll report. So we had 114,000 jobs in the month of July. The market expected more. We had negative revisions to prior months, which, by the way, say 12 months ago, the market would have loved this because it would mean inflation's going to slow. But there have been other signs of easing of tightness in the labor market. And by the way, I'm very careful to say easing of tightness because the labor market has been very strong. Notwithstanding the recent revisions from the Labor Department in terms of the last 12 months of job creation, even with those revisions, job creation has been very strong. And by the way, historically, those revisions tend to get revised the other way around, get moved higher. So I think you're going to end up finding over the last 12 months, 200,000 jobs per month. That's more than the economy can normally handle. So we had one bad month of labor market data. People basically hit the panic button. We had the carry trade unwind relative to funding out of Japan. I think that was a healthy moment. It was very good for people to see that markets too also go down. They don't just go up. I think for many investors, it was a great opportunity to add capital. One of the common themes I've heard discussed in Australia and other markets around the world all of this year is how high net worth individuals in particular had too much money in cash. And basically, if you think about it, through 2023, a lot of us kept waiting for that recession that never came. But it wasn't so bad because you were getting 4 or 5% interest rate on your cash, which after years of earning zero was pretty nice. The problem is, we all know rates are likely to come down. People have been waiting to put their money to work. They wanted a sell-off. Well, we got that sell-off in August. S&P down 9%, the Topix and the Nikkei down 25%. This to me was one of those opportunities where it paid to basically take a long-term view, put money to work. And so I would say, yeah, my conviction is actually higher than it was in February.
Okay, well, we'll come back to that. But you mentioned jobs data. Let's talk about the Fed. Now signaling the start of its rate-cutting cycle next month. Jerome Powell basically holding up a giant sign at Jackson Hole saying, we're going. Let me ask you this. Do you think they are getting the timing right to engineer a soft landing?
Well, I mean, had I been a board member at the Fed, I would have voted to cut rates on July 31st. But let's be honest, cutting on July 31st versus September 18th in the big picture doesn't really move the needle. I think the Fed probably, in hindsight, we will say, made the right call waiting for September. They needed just enough other pieces of information to know for sure that inflation was headed back towards the 2% target, to know that basically the balance of risk had basically shifted from inflation being the risk to a combination of labor market weakening being a risk relative to inflation. And so I think they're handling this pretty well. And keep in mind, by the way, they've already removed $1.8 trillion of assets from their balance sheet. They kept rates at 5.25 to 5.5 for a long period of time. I think the rate cuts we'll get through the end of this year will be the right call. And I'm expecting 25 basis point rate cuts. I do not see any evidence that would warrant a 50 basis point rate cut in any of the remaining Fed meetings this year. My view of the economy really hasn't changed materially, and that is the Fed easing cycle will probably end at somewhere around 3.5% Fed funds, not 2.5 to 3%.
Yeah, well, I was going to say I think Citi and others had that view of potentially maybe a 50 bip rate cut. So you've got a 3.5% terminal rate there for this Fed for this cycle. It's quite shallow maybe compared to what other people are expecting, what other people want. Let me ask you this then. How much credit does the Fed really deserve for whatever economic outcome arises? And I take it in your base case that's a soft landing.
You make it sound like an easy question. So I think the biggest part of the rise in inflation and the biggest part of the deceleration of inflation probably had little to do with the Fed. I think the Fed sent signals, they tightened policy, it was important, they had to do it in terms of their own credibility. But if you look at the evidence, a big part of the inflationary run-up was really related to pandemic effects on demand, where we had the surge in demand for goods when we couldn't travel and consume services. At the same time, we had the supply chain issues around semiconductor shortages, shipping bottlenecks, labor market difficulties. Those all converged, and what we ended up in the US was with 12% year-on-year inflation for core goods at the peak. Well, core goods have now been in deflation for the last year. And so effectively, you had a big run-up in prices, particularly for cars. Those car prices have been coming down now for the last 2 years. And so I think a big part of this really was supply chain shock and supply chain normalization. On the margin, I think the Fed, though, does get some credit for having belatedly, but then aggressively attacking the inflation problem through monetary policy. And so I don't want to take away credit from them, but the reality is it might have largely happened even absent the Fed's actions.
Let's talk about stocks specifically. We saw a period of rotation away from mega cap stocks into small and mid caps, perhaps disrupted there by what we saw in early August. Again, as I say, do you think that great rotation story is over, or is there more to go?
Well, if it was great rotation, we didn't get much of it. So I think it felt like the beginning one. I guess the way I think about this, there was a lot of discussion of Mag 7 or the big 6 in the S&P, which is basically the Mag 7 minus Tesla, versus the rest of the market. And I think we could easily make a case that the Mag 7 or the spectacular 6 have run too far and the valuations might be stretched. I think that's a really risky debate. I mean, if I step back and think in my lifetime, maybe the two biggest economic transformations are going to be the energy transition and AI. Well, we're 2 years into the AI story. Where it's going to go and at what pace, very importantly, is hard to gauge right now. So it's not a surprise to me that the market has basically inflated valuations of certain companies, which, by the way, have delivered some pretty tremendous earnings growth at the same time. In fact, they've derated from a PE perspective. So I don't spend a lot of time trying to think of, should I be trying to convince you to sell your Mag 7? But I do think what's clear, and I guess what I'm trying to say here, it's not a choice of one versus the other. I think you can have a decent amount of capital allocated to the Mag 7 and to the AI tech story. But what I see as the part of the market that's been left behind is further down the market cap spectrum. And maybe one way to think about this is if some of the biggest, most well-known companies are building the railroad tracks for AI, the next part of the story is who's going to ride on those rails. Which companies are going to make money from being on those rails? I think there are going to be a lot of opportunities across a range of sectors. Slightly switching gears, though, by the way, the other piece of the story is small cap definitely benefits more from lower interest rates than large cap. Now, I've already said I think the 10-year yield should be higher in 12 to 18 months than it is today, but short rates will be lower. And if you look at in the US market, the Russell 2000, the index for small cap companies, has twice the debt to cap of the S&P 500, and 45% of the debt is floating rate versus only 10% for the S&P 500. So I think there is an argument for small cap on the back of lower interest rates, raising net income because interest expense goes down, in addition to potentially finding some of those companies that might ride the rails of AI. But I think really when you're talking AI, it's going to be in that larger cap space that you see some of the biggest beneficiaries.
And then beyond equities, where do you see the most opportunities across maybe some of the other major asset classes?
Yeah, so I tend to kind of always think of this in my own framework as fixed income, then equities, then alternative assets. And fixed income, I've already talked about duration. I prefer to be short to intermediate duration. I think that's a better place to be. I'd rather be up in credit quality, meaning higher credit quality than lower credit quality, because back to your credit spread question,
Yep.
if I'm wrong about the economy and we don't get a soft landing, if we do get a recession, it's still probably going to be short and shallow, in which case investment grade spreads would not widen very much, but high yield could widen quite a lot. In equities, I do think allocating that extra dollar of capital to smaller cap and mid cap stocks is a good idea, and trying to find ways to kind of diversify the drivers of risk. So I've been quite positive for some time now on Japanese equities. I think there's a real structural story there. I would love to tell you that I'm bullish on emerging market equities, but right now the biggest risk to non-US equities versus US is November 5th, when the US election happens. If Donald Trump wins and he does what he said he would do and imposes a 10% tariff on all imports into the US, a 60% tariff on imports from China, it's going to be hard for a lot of non-US markets to perform well in that period. So I think the US, non-US is in a little bit of a holding pattern. And then I do think there's certain other selected themes like energy transition that could be a good place to be. To your question though, other asset classes, 2 years ago, if we'd sat down, I would have said I was worried about inflation being sticky in the long run, maybe 3% inflation being the new normal. My concern on that has gone down a little bit because of AI, because I think AI will be deflationary for services because of the productivity gains we'll get. But the logic behind me being worried 2 years ago was changes in global supply chains, which I just published with our Geopolitical advisory business, an extensive report on global supply chains. Welcome people to read. I think you're going to see incremental cost from those changes. And number two is the energy transition is going to be expensive. And so because of that view on inflation, I tend to prefer real assets, income producing real assets. So I'm thinking infrastructure is a great place to be. I do think there's also an opportunity over the next few years, not necessarily right now, in real estate in terms of trying to find opportunistic real estate strategies could be a good place to be. And I purposely said income producing real assets because I still don't know how you can ever put a price on an ounce of gold because it doesn't produce income. In fact, if you have physical gold, it costs you money to store it. And we can just completely ignore crypto because I don't see value there.
You mentioned geopolitics. Let's pick up on that. I know you look at the impact of geopolitics on financial markets closely as well. Do you think the lasting impact of geopolitics on markets has lessened, increased, or stayed much the same over the course of 2024?
The importance of geopolitics has increased,
Yep.
but I don't know that the market reflects that. And in fact, I think for a lot of investors, I mean, I've been in this industry for 30 years now in the financial service industry, investing for over 20. Historically, you've been paid to ignore geopolitics. People who reacted to geopolitical news often lost money. And if anything, you were probably supposed to buy when everyone was selling and panicking, running for the exits. I think the risk right now is, if you look back to the Cold War between the US and the Soviet Union, there was very little trade. I think it was something on the order of $2 billion a year of trade between the US and the Soviet Union. Well, with the US and China, we do almost that much every day. So these economies are so inextricably linked that the idea that you can have geopolitical tension that leads to protectionist moves or other trade and capital flow barriers, that the idea that that would not affect the value of the companies in which you invest is somewhat ludicrous. And so I think, A, just given the nature of the countries involved in the geopolitical tensions, that's different. And B, we have two live kinetic wars in the world right now that are actually quite important between Russia, Ukraine, and what's going on in the Middle East. And yet, amazingly, you wouldn't really know it from looking at oil prices, and you wouldn't necessarily know it from looking at equity prices. And so I worry that investors are thinking it's the same old story, just look beyond all of this, focus on that company-specific news. But in many cases, let's go back to the US election. On November 6th, or soon thereafter, hopefully, we'll know who won the US presidential race. Those tariffs make a very big difference to a whole host of companies. If there's a 60% tariff on imports from China, you're going to have a lot of companies in the US who are very dependent on imports from China to sell to their customers. Can they raise prices to make up for that tariff? Depends. Is it a discretionary product or a staple? If you're buying a new smartphone and there's a $200 tariff on your smartphone, are you going to pay an extra $200 US for another phone? Or are you going to wait an extra year? And so I think that's geopolitics, and that is a direct impact on corporate P&L, corporate profit margins. And so I think for investors, ignoring this is at your own risk.
Ron, thank you very much for joining us. Thank you for joining us out here from New York, and hopefully we get to do this again early 2025 when we know who the next president of the United States is.
I look forward to it. Thanks a lot.
And thank you for joining us for another great edition of Views from the Top. If you enjoyed that interview, you can subscribe to the Live Wire Markets website as well as our YouTube channel, and we'll see you again very soon. Goodbye for now.